Welcome to the Growth Minded Accountant podcast, where our experts will share best practices on running your firm in the digital age. This podcast is brought to you by CountingWorks Pro. Let's get started.
So welcome to another episode of the Growth Minded Accountant. Today we are doing a little bit different than our normal marketing practice management for tax and accounting firms. We're doing a special podcast episode, and the title is Rising from the Rubble, Navigating Tax Implications for Homeowners Affected by Disasters. My name is Lee Reams II. I'm the founder and CEO, and today I'm joined by our chief technical editor, who has a very familiar name as well. It's Lee Reams Sr. He's an enrolled agent. Lee, if you could say hello.
Hello, how are you doing?
Well, I'm doing great, and I'm excited to talk about this. So a little background, we are a practice management marketing platform for tax and accounting firms, but we also have a continuing education division. And Lee Sr. basically worked the last week or so and pulled together all sorts of resources that we had on disaster, casualty losses, things like that, really to answer some of the questions that were coming through some of our support forums from tax professionals on the recent Los Angeles fires. So we do have a full comprehensive course that's available at taxcpe.com for a tax pro looking for CPE credit. But for this podcast, we're just going to talk about it on a kind of a high level. The audience can be a tax pro. You could also be an individual kind of interested in understanding your options and what all this means to you going forward. So the reality is, wildfires, whether it be hurricanes, tornadoes, and other calamities are striking more frequently, leaving many families grappling with both emotional and financial turmoil. Obviously, insurance is a big issue, rebuilding times, cost of rebuilding. So beyond the immediate concerns, as finding a new house, replacing your personal property, those affected also face complex tax considerations. Yes, you heard it. It's not just whether I'll get my insurance and whether I have to pay my mortgage, but there's a lot of different tax consequences when you go through this type of event. So understanding your options is essential for making informed decisions and really making better choices, financial choices after the aftermath. I'm going to preface this. If you are a DIY or a taxpayer and you're listening to this podcast, the things we're talking about today, I believe you should talk to a tax pro, whether you're CPA, enrolled agent, a tax professional. This is not something we want you to DIY, but we do want to open your mind to all the different opportunities that you may not have known that existed. So in this podcast, we are going to delve into specific tax rules, some relief provisions and strategies applicable when your primary residence is lost in a federally declared disaster area. Obviously, there's state issues as well, then even some local Los Angeles ones. So we hope this is a comprehensive exploration and you'll get a lot of it. So thank you for joining us, and without me continuing to talk. All right, so let's jump into this, and let's start with the basics. What is a casualty loss versus a disaster loss? I know there's some tax terms, some recent legislation that might have altered things, but kind of explain to the audience what these terms mean to them right now.
Well, a casualty loss is when you have maybe you have a car wreck, or you break a valuable dish or something like that. That's a casualty. But the tax law doesn't allow casualties anymore under TCJA, at least through 2025. Unless they extend that provision, which I think they probably will. But what we can deduct is disaster losses. So if the president declares a disaster loss, then it's deductible on your tax return. Although it may not be deductible, it may be income. So we'll talk about that as we get into this.
So does this matter if I itemize or not? Kind of explain to me how this might be deductible on my tax return.
Well, for disaster loss, whether you itemize or whether you take a standard deduction, you can deduct the disaster loss. What they do is they allow you to tack the disaster loss onto the standard deduction. So whether you itemize or not, you can still take the disaster loss.
And let's just talk about this. So let's say my house was I had a house in Malibu in the Costa neighborhood. I had built that house after the 1993 wildfires there. It took me 5 years to get a permit. I bought the burnout, 5 years after the fire. And this just goes to show you how long it takes communities to recover. So it was at least 10 years from fire to when I moved in. And I built a house, and luckily somehow like 4 houses in the hill in the Costa survived. Mine was one of them, but my next door neighbor's house is gone and everyone past them is gone. So let's just say the value of those houses at the time was $5 million. I had a $2 million mortgage on it, and I was now affected by a cap on my insurance. When we say there's a disaster loss, how does this affect it? Like, is my insurance, let's say I'm not going to rebuild, but I had a loss in value. Am I able to write off certain parts of this, or kind of how does this work in the tax code?
What you're talking about is what everybody thinks it is. Okay. So let's say, how much did you cost you to build a house? What, 200,000?
Where? In
Oh,
California? No. I mean, so the minimum, let's say that house cost $1 million back in the day to build, right?
okay. So your basis in that home is $1 million. Now you got insured. Fire comes along, burns it down. Insurance gives you $5 million. Oops, you got a $4 million gain.
How am I dealing with that?
You don't have a loss. Well, first of all, if you've lived there for 2 out of the 5 years and owned it 2 out of the 5 years, you're qualified for what we call the 121 exclusion, section 121 exclusion. So you can, if you're married, you can deduct 500,000. And then there's a revision in the code section 1033 that you can defer the gain and allow you to reinvest it in another property within 4 years. Now, normally section 1033 only allows 2 years, but for disasters, it's 4. So.
All right, so let's go the opposite of my use case. And I know the guy that bought the Succession house, he paid, $70, $80 million. He didn't build that house. This was an investment. But basically he was not insured, let's say. He may or may not have a mortgage. He may have pure cash. He has a true disaster loss. What are his options then in that scenario? And there's another investor I know on Carbon Beach who had just, built a place and, spent $18, $19 million building it, and was just getting ready to list it for 28 or something. And it just burned down. What are their options as far as handling these losses against future income or, other tax years?
If it's uninsured, then he can deduct the loss. And if the loss exceeds his income for the year, he gets an NOL, and he carries forward that loss until he uses it up. So,
but is there a cap on that NOL, or is it each year? Or
no cap, no.
So if I am a high net worth person and I make $5 million a year and I have a $15 million loss, I could write off 5 each year for 3 years. Is that the way it works?
You write off all your income each year until you use up the NOL.
So does that mean I am paying $0 on those 3 years worth of income?
That's correct. Yeah.
Okay. All right. So now I'm getting an idea of how this works. So let's talk about, how do I actually claim a qualified disaster loss? Like, what are the steps I need to do with the IRS? And then there's state issues too. If you can kind of get into the beginnings of, how does this work?
Well, first of all, you got to apply for FEMA, because if you're in that disaster area, FEMA is going to give you some money. So if you're uninsured, the way FEMA works, if you listen to the news, as long as your losses are covered by some insurance, or if you do a GoFundMe or something like that, they won't cover that, because they only cover what you don't get reimbursed for some other way. So you got to go apply. You got to apply for your insurance first if you have it, and then you go apply for FEMA, and then FEMA may give you some money, and then that's going to reduce your loss.
So, okay, but that answers that part. How do I actually, so let's say I do have a loss. How do I put that into my calculations for my tax planning? How am I working with my CPA to kind of figure out how to take the loss? Is there any tax planning strategies around this?
Well, your tax pro is going to calculate the loss, and for your planning purposes ahead of time. And if it's a huge thing, you may not have to worry about that. You can just know you're going to get a big loss, have an NOL, so you don't have to worry about any planning. So you get done a lot of ways. Of course,
well, you could, because perhaps you have a a business that you were going to sell in a certain amount of time, or you have some sort of capital gain coming that you can move forward to accelerate it and have a tax-free event from that. Is that not a strategy?
That's true too. Yeah.
You had mentioned GoFundMe, and I just feel there's a curveball there. If I raise $50,000 on GoFundMe, is that taxable to me?
If it's not used for charitable purposes, yes.
Well, am I a charity? I'm raising the money as a fund to
Well,
help
no,
me get
it's going to offset the gain, Lee.
right. So I'm just throwing that out there because people forget about that.
Back up a minute. Since you threw in GoFundMe there, if you're trying to raise money to start a business or something like that, there are specific rules that the SEC has that you can only limit. You got to check the person's who's investing, their net worth and stuff like that. So,
yeah, I'm talking specifically for the fire. I've seen a bunch of GoFundMes for families in the affected areas, whether that be in the Pasadena, Sierra Madre area or the Palisades, Malibu area. So I just wanted since you brought it up, I was like, all right, let's talk about it. So let's talk about a little bit about insurance coverage and reimbursement. Because I have heard, and was it Josh Altman and a couple of realtors have been saying, hey, I think 50% of the residents of the Palisades won't be back. 70%, even numbers that are higher. I've gone through building in these areas, and I know Newsom is saying he's going to make it easy, but the California Coastal Commission is beyond daunting and frustrating, and it's one way to make. I always say it's one way to make any liberal a right-wing Republican after they go through it. And I'm not talking politics here, but I think it's kind of funny. So let's say that people do decide to walk and they sell their lots. So let's get into the math here and how this works. So I'm in the Palisades, I'm in the Palisades, Huntington, and let's just, for the sake of this discussion, say that the lots are worth $5 million after it's cleanup. I had $3 million through the FAIR plan. That was my cap. So I have $3 million insurance on my house. My house was worth 15, but my basis, let's say, was 10. This is getting a little complex. I would say if I sell it for 5 and I have a $3 million insurance policy, I'm only at 8 million. I have a $2 million disaster loss. Is that correct in that kind of scenario?
Well, we're talking about your basis, right?
Right.
Everything, what it cost you originally, and then you subtract everything you get back from your insurance and from selling a lot, and the difference is a loss. Yes.
If it's a gain,
yes.
What's happened? I guess you're paying tax. Is that a traditional home,
No.
primary home?
That's your home that burned down, so you get to exclude the section 121, 500,000 if you're married, 250 if you're single, and you can use 1033 to defer that for 4 years. You can buy another home someplace else and reinvest it. The part you don't reinvest in would be taxable.
So let's talk about that. I thought there was a 2 out of 5 year rule. So let's say this scenario, I'm renting for 3 years. I have not lived at my primary residence in that time because I hadn't decided yet. And then all of a sudden I just give up. I sell it then. I haven't theoretically been living in that property 2 out of the 5. Do I still get the same benefit as my primary residence? Or does that...
You don't get the $500,000 exclusion or the 250.
So is there a period of time, have they said?
But you still get the 1033 deferral on the whole thing then. So you can go reinvest it in another home.
So I can use that money but let's pretend I didn't do that. I continue to rent. Is there any documentation on how quickly I have to sell? Is there a year? I guess there's a 2-year, I don't know, how would that, I guess you'd have to look at that, wouldn't you?
Or you can't figure your loss until you get rid of the property. So you've got to put things on extension and figure it out. There's one other issue too about the vacant land after the house is burned down. And back up in what was the name of that place up in Northern California?
Paradise?
Paradise.
Yeah.
In Paradise, I had a friend of mine who called me and said he lost his rental, and he had some passive loss carryovers on it because he couldn't deduct them all. And he says, "Do I get to deduct my passive loss carryover now that the house is burned down?" I said, "No, you have to have complete disposition of the property. So the passive losses are stuck with the lot until you sell the lot, and then you take your passive losses."
So then any of these landlords that had 5, 10 houses in the Palisades, for example, or even one of these condo, I read was a 48 unit condo complex went down. How does this affect them since they're in fact a business and a landlord? How does the disaster loss? I mean, they obviously have real losses just like everyone else. What are the tax ramifications for them?
Well, we still go back to basis, right? And so basis versus what you got from insurance, and you got your loss. So or gain can work out both ways. So
Yeah, very true.
everybody forgets is about when they get the insurance payout, they probably end up with a gain.
Well, if you're properly insured, yes, obviously that's the big game.
Yeah.
But some of these high-end homes that are recently built, at 1,000 a square foot, and there's an 8,000 square foot house plus landscaping and everything else, the basis can be pretty high. I don't know if you're insured enough. So I'm going to pivot a little bit. I have heard the term Stafford Act. What is that, or how does that apply here?
Stafford Act is what gives the money is the legislation that funds FEMA.
Okay.
So it just basically gives money to FEMA and has rules about FEMA hands it out, and I'm not familiar with all those, but
Yeah, that's fine. I was just bringing it up because I keep reading about it and hearing about it. So when it comes to FEMA assistance payments, the best way to go, there is a phone number. We'll give it out, 800-621-3362. It's a helpline. And then the FEMA.gov is the website you would want to go to. It's /assistance/individual/program. But that would give you access to the FEMA app, I assume, right? And that's where I can start applying.
correct. Or you also FEMA has an app on the phone that you can activate and do it through your smartphone.
Okay. I was watching YouTube, which I'm a premium member now. All I do is watch YouTube and learn. But there was a guy that took a boat out, and then there was an environmentalist they were interviewing about the debris and the next rain and how toxic it is, and not where the beach closures are. And they talked about debris removal and demolition expenses. And when you see the Malibu coastline, for example, I cannot even imagine what it's going to be like to clean up all that versus because of the environmental issues. It's on the coast, it's on the sand, the water's there, there's seawalls, there's all kinds of things. But it brings into the expense of debris removal and demolition expenses. How does that play into? Does that just add to your basis, or how does that apply with the disaster loss?
Well, it's probably one of the most unfair things around because the demolition costs were actually, the way the law is written, they were thinking about you're tearing down an old house someplace and building a new one. So the demolition costs get capitalized into the new house. So you're not deducting them. And that's the way it plays out even in a disaster. So you're not going to get the demolition costs. But I think in case of the LA fires, FEMA is going to pick up the cost of a lot of that cleanup. So
and just to reference, FEMA declaration zone is at 4856. Does that sound about right? And if you Google that, it has some things that like deadlines have been extended for tax returns, contribution to IRAs, other things. I don't want to go into details here, but it is something to think about. Your tax pro will kind of review that with you. I think even if you have partnerships or S corps, there's some delays as well, which comes into the filing extensions.
all of them are delayed until October 15th, both state and federal. And for federal, even some of the payments are delayed till then. And the governor just came out with a executive order where the property taxes don't have to be paid until, what is it here?
You can add the
April
date in.
10th of 2026. So
Wow. I'm going to go off this seminar, or not seminar, podcast a little bit. I did write an article for taxbuzz.com where we talked about the property tax issues and the mansion tax issues in Los Angeles, the loss of tax revenue. But if your house is gone, your basis is obviously less. 100% go to the assessor's website and get your property tax value written down as quickly as you can. I think this is an important, obviously the date of the incidents will help there. As far as filing for extensions, is it IRS form 4868, I believe, is what you would need. You can get that online, Google it. That's kind of basic. Are there any other instructions people need to think about?
But you don't need that until after October 15th.
Okay.
And by the way, so you got to get your property taxes adjusted, you have to do that within 12 months. And the loss has to be more than 10,000. So,
well, most of the people we're talking about are way more than 10,000, obviously. So I think they're going to qualify for this. What is the method of proving losses? Are there safe harbor methods you can use? Do you have to itemize everything? How do you track and organize all of this?
Well, this is the big problem in a fire because everybody's records got burned up in the fire. So they don't have proof of what they paid for the house or anything. And most people don't keep those anyway. So what they have several safe harbors, and one of them is you can do the contractor's estimate. You can do FEMA's estimate. So there's 3 or 4 safe harbors you can use there, which probably are not the best, but if your contractor gives you a fixed rate for what's going to rebuild your house, you can use that. But you can't improve it.
Well, that's the issue, though.
Yeah.
I mean, most people are improving it, right? And not everyone had a brand new house, so there was a lot of wood shingle houses, wood houses. Well, obviously, lots of improved places, but not everyone could deal with that. So I want to talk about a little bit. You've mentioned a basis, and I just want to go back to the decreased basis versus increased basis. How does that work in a disaster area when I'm actually rebuilding on the value of the property?
Well, basically, your land is worth something, and you can always go to your property tax bill if you really want to use that. And it gives you an allocation between improvements and land, or you can get somebody to appraise what your lot was at the time, a forensic appraisal. Or in the case where you built your house, you knew what you paid for your lot, right? So that's your basis in the lot. So you just got to go back and figure it out. And this is really a complicated thing, getting all these records together for improving what it's worth, because it's probably all burned up.
Yeah, I mean, there's public records. There's a good accountant. You might have a lot of these records with your accountant in their client hub. So another reason not to DIY all this stuff. So I want to kind of understand qualified disaster distributions. This is something I don't personally know of. And what I didn't even realize, you can repay the distribution to your retirement account within 3 years to avoid taxation on the withdrawn amounts. Are you saying that we can actually take a withdrawal from one of my retirement accounts to help during this, or how does that work?
Well, the amount you take from your retirement account is only 22,000. That's not going to go very far for you, but you can take a loan up to 100,000. And you can pay the loan you have to pay back. The 22,000 you can pay back within 3 years, and you can bring the income in over 3 years. So you take 1/3 a year. So what's that? 7,000 and some odd dollars a year you can bring in as income, and there's no penalty. So if you want to just keep the money, probably not a bad bet.
So otherwise, if I let's say I have $1 million in my 401k and I just, economic hardship, am I just having to pay the 10% early withdrawal if I need the money? If I pulled 500 out, there's no way around that?
No. Well, the 100,000 you take on the loan.
Right, but I'm saying if I actually did a hardship withdrawal.
Yeah, no, you're stuck with the penalties.
Okay. All right, so let's talk a little bit about California, since these fires obviously occurred in Los Angeles area. Are there any groups or government organizations that I would need to deal with? Is there anything with the state tax code that I can utilize that I should be aware of?
Well, there's the Employment Development Department has already come out and they say you can request a delay, but you have to request them. And the California Tax and Fee Administration, is the one that collects the sales taxes. They said the same thing. You can get a delay on that, but you have to request it. And the State Board of Equalization, that they quote Code Section 170, State Code Section 170 to that says they have to reassess your property, and you got to get it done within 12 months.
Got it. So have I missed anything? And again, we didn't want to make this a huge, long podcast. I just wanted to give the basics, understanding the tax code, understanding the ramifications, and understanding too that it's complex. Working with a professional will be beneficial. Is there anything that I've missed? Some opportunities for taxpayers to explore? Maybe your business was located in the Palisades and it was burned out and you're out of business, obviously, but you're looking for a new location, trying to rebuild. Or is there anything that I've missed during this?
Well, there's one thing I think we forgot to mention here, and that you can carry back your loss 1 year if you have a loss. So if you have a loss in 2025, you can have the option to take that loss in 2025 or 2024.
So meaning if I had a big income year in 2024, and now I have a $3 or $4 million loss from and let's say I was in Hollywood, I was a producer, and I could make that kind of money, I could actually bring that loss back to the year before. Do I amend my tax return? Is that for federal only or state and federal?
State and federal.
All right, so something else to think about. All right, I think, go ahead.
Well, you gotta be careful when you do that. You gotta think about what your income is each year. And don't forget you get a carry forward if you get a large loss like you were talking about. You get the NOL would go forward then from 2024 into 5, 6, 7 on till you use it up, see?
Yeah, I mean, so I think what we're getting at here is, yes, this is tragic. Obviously, hopefully everyone survived. Memories were lost. But there are, the financial side, there are options. There are going to be ways to deal with this, whether that be not enough insurance, non-insured. I mean, maybe you paid cash for the house and you didn't have any insurance at all. There's a lot of different ramifications and ways to kind of look at what's the best financial option for me. If you are interested in learning more or meeting up with a qualified tax professional, we do have a marketplace called taxbuzz.com where you can search for people in your area that are, students of ours. We've already trained them about these subjects, and they'd be there to help you. And as you can tell, there's some pretty big numbers we're talking about when you're in a big, high value place like Palisades. Obviously, we're not going to forget the other friends that are in LA that also were affected. But go ahead and do that. I think there's anything else you want to add. Otherwise, we'll wrap this thing up.
I think we covered most of it.
All right. That wasn't too painful for you, was it?
No.
All right. Very good. Again, thanks for joining the Growth Minded Accountant. I know this is a little off topic, not on marketing, not on AI, which I'm normally all I do is talk about AI. But you did get to meet Lee Reams Sr. He's part of the brains in the training level on top of Max AI, our training tool. So a lot of knowledge there, a lot of human fact check stuff that we help train our model with, and which makes it so accurate. So hopefully we will see you at our next episode of the Growth Minded Accountant. I hope you find value. Feel free to share this with people that that were affected by the wildfires, or really, when you get down to it, a lot of different disasters. Obviously in Florida, there's a lot of hurricane issues, tornadoes in Oklahoma, Texas, whatever. So it's a trying world. We want to all stay safe, but hopefully we can use the tax code to help minimize the scenarios that we've talked about. Again, thank you again.